Hey traders, Jason here from Levitt Brothers. So I'm going to do an update of my State of the Market series. I like to do this about once every couple of weeks, maybe a month at the most. I post a lot of these charts on Twitter, so you can follow me there. So I post them on Twitter, during the weeks, and then once every 3 or 4 weeks, I'll do a summary where I get into everything that's going on. And just summarize it into one video as opposed to a bunch of individual posts on Twitter. So follow me on Twitter, and you can get these much earlier than I'm posting them right now. But anyways, these are real-time charts. These are the charts as of Friday's close. So I'm going to look at the indexes, and then I'm going to look at some breadth indicators just to kind of gauge what's going on in the market, and maybe it'll give us some sort of a hint of what we can expect going forward. All right, let's get to it. All right, so here is the S&P 500 monthly chart going back several years. As you can see, during an uptrend, it'll kiss along its upper boundary, drop to the lower boundary during a correction, then get back above and stay in the upper half, test the lower part, stay in the upper half again, and you can see going all the way until more current day, we see a move off the high. Failed to hold the middle band, and it's been trading the last 12 months or so, as you can see, within the lower half of the band. So in my opinion, and my assessment of this, is that we lean down, but it's not a strong lean down. You can see the slope of the upper band, slope of the middle band, slope of the lower band. They're not, they're moving slightly lower, but it's not really a steep slope. We've been just trading sideways up and down within the lower and middle band, upper band or the middle band being resistance several times, the lower band being support a couple times. So to me, this is like neutral with a slight bearish lean, but I'm not going to get extremely bearish until the bands actually start sloping down, and I'm not going to turn bullish at all or even have a strong lean to the upside until we can get above the middle band and actually trade in the upper half. So this is where we are going back several years. Obviously, this has been a lot different than what we've seen with other corrections over the years. It is what it is, but it also kind of classifies this as, hey, maybe the market's in not great shape, but it's not actually in horrible shape either. If we could just move up to the upper half of the band, it wouldn't be that bad. All right, let's look at the weekly now. So here's the weekly. You can see the big run up off the COVID low, huge rally. This is one of the greatest rallies in stock market history. So I look at this and I see, a high here, a low here, a higher high that gets rejected by the 50, a lower low, so volatility expanding. Then we get a high here and a low here, so now volatility is contracting, and then we get a higher high and a slight higher low. So overall, I would simply say that this is kind of neutral. It's like volatility expanded, volatility contracted, price is unchanged going back 12 months. The moving averages here are the 8, the 21, and the 50, and you can see they all come together over here. I don't know if you can read this in the top left corner, but they're all within 6 points of each other. So 6 points with the S&P 500 is almost a rounding error. So you got 8 weeks, 21 weeks, 50 weeks. The average price over all those look-back periods is exactly the same. So I'm neutral. I've been saying at Levitt Brothers I'm neutral. I've been saying that for a little while. I definitely had a bullish bias in January because trading was extremely good, and at the beginning of February I classified it as a resting period or a pullback within an uptrend. But eventually the pullback with quote unquote pullback within an uptrend lasted too long, went too far, and it was no longer a pullback within a mini uptrend. It neutralized the uptrend, and then we just went back to being neutral. So that's my take right now. We're neutral, which means we don't have any directional momentum to play. That's just the way it is. So I'm taking a lot of the same types of trades, but instead of holding for a couple weeks, I'm holding for a day or two. I'm just being happy with making a point here, making a point there, repeat. It's kind of the kiss of death in trading to take a trading style that worked over here and force it on a market that's doing this. Like that, if you do that, you have no chance of surviving. You have to note what the character and personality of the market is, and then make slight adjustments to your trading style. Okay, what worked over here in 2021 might not work as well in 2022, 23. And you have to note that. Don't fight it. Don't negotiate with the market. Just note it and make whatever slight adjustments you need. All right, here's the daily chart. Just zooming in on the last year, you can see just the sloppy up and down movement. The index gets above moving average, it gets below moving average. Nothing really sticks, and right now, all the moving averages are fairly close together and pretty close to flat. So overall, this is very neutral. But let's remember, if I could spin this to be bullish, this is what my argument would be: is that during this entire time here, inflation has either been moving up or has flattened out, and it's really high. It's a 40-year high. It's the highest it's been since the 70s. So the fact that the market has moved sideways when inflation's been really strong is pretty good. During this entire time, the Fed fund futures rates has been slowly increasing. So again, if the Fed funds futures have gone from 0 up to near 5%, and the market has simply been flat during that time, that's pretty good. And then you can zoom in over here and say we had a mini banking crisis. We're still in it. We don't know what's going to actually happen. We don't know what kind of contagion is going to take place. But for now, we're still in a mini banking crisis. And again, the market's pretty much unchanged going back a couple of weeks. So relative to the bad stuff that's going on, this isn't that bad. For the market to simply trade flat in a range, given inflation, given rates, given the banking situation, it's not bad for the market to just simply trade flat. Okay, that's not a reason to just buy and hold, because we got some nice swings here to play, and the market could go down. But it's not bad that the market has been able to hold up. All right, let's look at some breadth indicators. So here's the S&P 500 versus the 10-day, 20-day, and 50-day moving average of the NYSE AD line. So you can see that a lot of tops, and remember this entire time that the chart, this chart goes back a year, so the entire chart that this shows, the market's pretty much trading in a range. But you can see a lot of tops are picked off with divergences. You can see that happens over and over. Pretty much every, all the major tops happen with, we're kind of not pinpointing because you never know exactly what day, but we got warnings, days or a week in advance that a top was probably forming because of the divergence between the market and the 10-day of the NYSE 80 line. Bottoms also can have divergences. So I want to pinpoint where we are right now. Let me delete that. If you get a big move down like this, then this tends to be a washout, and a washout followed by a washout is playable. We're likely to get a reversal. If that doesn't work, then we get a divergence, and then that's definitely playable. Okay, so this is a washout. We're pretty close to a bottom. A minor dip below 0 could be considered a dip within an uptrend, but we got a dip somewhere right in the middle. Okay, it went further than a dip within an uptrend, so we'd have to reclassify this. Like this is move up, dip within an uptrend, and then move up. This is a dip within an uptrend as it goes up here. Okay, so those are dips with an uptrend, but at some point when this indicator falls too much, it's no longer a dip with an uptrend. The pullback lasts too long. It goes too far, and the uptrend has been negated and neutralized, and that's what happened. So the market moved down a lot, but we didn't get, it got neutralized, but we didn't get a total washout like we did back in September here. So zooming in to near term here, you can see we got the 0 line here. It's pretty good. We got a little bit of a left side here, a right side here. If this can hold up and get back above 0, then I think we have a moderate chance of moving up back to 4,100 or above. So that's what I'm looking at right now. Again, this was like right in the middle. It's not a pullback with an uptrend anymore, but it's not a total washout. It's somewhere in no man's land in the middle. Don't know what's going to happen. So this has to, show its cards a little bit. Okay. Sometimes we look at these charts and we're looking for some sort of a conclusion. Sometimes our conclusion is that we can't come to a conclusion. Sometimes we just need more information before we actually develop a bias at all. Here is the S&P 500 versus the breadth thrust indicator, which uses volume instead of just the highs. Instead of just advancers and decliners, we're using advancing volume. So again, a lot of divergences help pick tops. Divergence here, divergence here, divergence here. Lots of divergences within this period picked off by pinpointed highs, divergences on the downside also, as you can see here. So going to today, we had a pretty good divergence here. Okay, lower lows from the market, higher lows from the thrust indicator. Didn't last long. It only lasted a couple of days before the banking crisis hit, and we rolled back over. So this level here is just like in the AD line, is kind of a no man's land. Okay, a key level here is 0.4, so I'm going to draw that. Typically, when you get a pullback to 0.4, that would be considered a bounce, not a bounce, a dip within an uptrend. So this was down to 0.4. This was down to 0.4, but like this one went through 0.4. Okay, you can have a little bit of a wiggle room there, but that went through 0.4. But again, we have a print here, which is no man's land. It didn't find support at 0.4. It didn't completely wash out like in September. We're signed kind of somewhere in the middle, non-committal. Now we're a bit back above 0.4. We'll see what happens. We need more information. This is flat. This is kind of flat and neutral. We're not getting any hints that this is leaning to the upside. It is what it is. We can't have a strong bias right now because there is no strong signal from the indicators. All right, this is the NASDAQ versus NASDAQ, new highs in green, new lows in red, and then the high low below that. So I want to point out that when you look at, first of all, you see these are steady prints. That's pretty darn good. So even during the late December drop where the NASDAQ tested its low, we had pretty steady prints here, which was really good. That was a good sign. That told us that we're going, NASDAQ's testing its low, but yeah, we're getting a steady print of new highs, which was a really strong sign. Even like over here when we're at the low in early January, we had almost no new lows over here. So it's a great sign that told us that the market probably wasn't going to fall much further. And not only did it rallied really nicely and gave us a lot of great setups in January. But let's look at today. I'm going to get rid of that stuff. Let's fast forward to today. This is a move up. This is a dip within an uptrend, and then a move up here. And what we have here is even though the current price here is like 18% higher than the low here, new highs over here are obviously much less than they were over here. So something different is going on here. And what that has caused, it's the high-low can't get back above zero. Okay, it's kind of like, it looks almost like this, where starting from below, it gets up to zero during a little bit of a bounce, but it just couldn't get back above zero. And because it couldn't get back above zero, the market mostly traded flat, in this area. And that's what I see here. We got a dip below and an inability to get back up above, even though we've had a decent rally here. This rally is almost 10%, and yet the high-low can't get above zero. So that's what I'm looking at right now. I'm looking at the fact that like we have prices here that are much higher than here, but new highs are much less than new highs here. And then we have that high-low is below zero and can't get above zero, which is kind of like what happened over here. So right now I'm looking at, this tells us don't expect the market to move up. It could pop right now, but unless we get an expansion of new highs, it's not going to go very far. Here's the NASDAQ up top. In the middle, we have NASDAQ 100 stocks above their 50-day moving average and NASDAQ stocks above their 50-day moving average. Okay, so the NASDAQ 100 stocks are your 100 of your biggest, highest quality companies, and the NASDAQ just includes those plus several thousand others, and of those several thousand, some of them don't even deserve to be publicly traded companies. So I want to just zoom in, just looking at little divergences are always going to happen. The NASDAQ 100 should be stronger than the NASDAQ. So currently, we have about 51% of NASDAQ 100 stocks are above their 50-day moving average. Now look at the NASDAQ. It's been trending up. The 50-day moving average has been trending up for 2 months, more than 2 months. The index is above the moving average, and we have 51% of a NASDAQ 100 stocks above the moving average, which is pretty good. Or I shouldn't say it's pretty good, it's about what you'd expect. But you look down here and we have less than 20% of NASDAQ stocks overall are above their 50-day moving average. So that's, divergences are fine, but a divergence that big can't last. There's just simply no way that the NASDAQ is going to continue up unless you have better participation. This tells us that you have really big companies, and we know that Microsoft and Apple are doing really well. We have really big companies that have like an outweighted influence over the index, are doing well, which causes the index to do well, but beneath the surface, participation is pretty bad right now. Okay? Less than 20% of stocks are above this moving average. That can't last. If the market tries to move up, but we don't get improvement here, market's not going very far. Okay, next chart, same numbers, except we're using the 200-day moving average instead of the 50-day moving average. The message is the same. Percentage of NASDAQ 100 stocks above their 200-day moving average has been above 50% pretty much this whole year, and right now it's at 61%. So not bad. The 200 here in red, it has come down, is starting to flatten out. We got some support there, not there, but we quickly reclaimed it. But it's definitely it's starting to flatten out here right in the near term. So this is good. 61% of NDX stocks are above the moving average, yet only 29% of NASDAQ stocks in general are above. Okay, a little bit of a divergence is fine, but an extreme divergence just isn't going to last. We can look over here to end of November, beginning of December, when these prints were in the 45 to 55% range, and you can see this huge gap here where the number of NAS stocks above the moving average was only like 30 to 35%. What happened? End of December, the market went down. Okay, then let me delete that. Then when we got to move up in January here, got above 50%, we actually got some improvement here, which supported the market, which enabled the market to do really well in January into the beginning of February, so that it was able to last. So last chart, S&P 500 up top, the 10-year yield down below, they have moved opposite each other, so they've been inversely correlated. So when the 10-year yield has moved up, the market has moved down. 10-year yield up, market is down. 10-year yield up, market is down. And of course, the opposite is true. When the yield has dropped, the market has done well. Yield has dropped, market has done well. Yield has dropped, market is trying to do well, but it's not there yet. So we'll have to see. So this should help the market, but so far it's only helped it a little bit. So we'll have to see what happens. This correlation's been in place for several months. If the correlation breaks down, then we're going to have to make an adjustment to our trading. For now, this gives us a little bit of a tailwind, but it's not helping too much yet. Although you can argue that, hey, we have a banking crisis started here, so the fact that it's been able to even stay flat is a good sign. All right, so overall, market is pretty much neutral. Okay, indicators dropped. They're no longer suggesting a dip within an uptrend, but they didn't have fall to washout levels either. So the indicators are mostly neutral. Maybe some lean a little bit up, some lean a little bit down. We definitely have criteria in place that certain things have to happen in order for us to have a stronger bias. As I said, sometimes your conclusion is that I can't make a conclusion because you just need more information. So overall, I'm just saying the market is kind of doing well because it's been able to absorb a lot of bad news over the last 12 months and stay neutral. But then again, the indicators don't suggest that there's any strong momentum. It doesn't suggest that there's like strength beneath the surface. There's no reason to be overly bullish or bearish right now. You just have to note that is the condition of the market. That's the personality of the market. And you got to make a slight adjustment to your trading style. All right, hope this helps. We'll see you next time.